Hello everyone. Global markets have become increasingly interconnected and the correlations shoot up, especially during periods of crisis, like the one we're going through right now. If you're investing, I think it pays to understand various factors that drive global markets, equity, bond and forex markets, which inevitably influence how the Indian markets function. This becomes even more important if you have international exposure in your portfolio or if you're planning to have it. For example, if you're investing in the US, the first thing you're essentially doing is buying dollars, and then comes the view on the asset class that you are investing in. So it is essential that you understand the interplay of various markets globally. Today we have Debashish Bose with us. Debashish is currently the head of product management at DSP Mutual Fund. He has been in the investment business for 20 plus years across asset management, wealth management, institutional equity broking, and global macro research. He's worked across markets in India, US, Europe, and Asia, and has relationships with institutional and family office clients in all these regions. He has deep exposure across global markets throughout his career. I think we can leverage that experience to discuss how global factors are affecting our investment landscape in India. Debashish in the next few webinars will give us an overview of what is happening globally across equities, bonds, and the forex markets. And also, he'll talk about a framework for investing in gold. Thanks for taking out the time, Debashish, and doing this with us. Over to you now.
Thanks, Mohit, and welcome everybody. So, as Mohit described, we'll kind of take things through a few different sessions because it's just that the body of material we are covering is vast. I'll try to crunch it down as much as possible, but it's important that we kind of look at it because for all of you who are sort of looking to venture into investing abroad, I mean it is a real big wide world, so to speak, and very important in any investment venture to first kind of look at where the risks are, how the risks can sort of affect you, and based on that figure out when it makes sense to take action accordingly. So how we'll try to structure it is in the first part I'll sort of really go through what's happened in markets around the world, in asset classes around the world over the past 2 decades, and also just layer in a bit of history to it so that we kind of know how we've got where we have got today. And from there, we'll kind of take it into where the current situation lies, which is in terms of, how the virus has affected the markets this year, and in turn, how markets have responded, and more importantly, what's really kind of happening behind just the visual effect of what's going on in the front line with the markets, what's sort of really happening behind the scenes. So we could probably think of that as the first part. The second part will kind of use all the information we've collected in this first session and take it into trying to develop a probable roadmap for the path ahead, especially over the next decade or so, how we could have the investment environment shaping up with a set of reasons why I think certain set of things will happen. Now, when we are projecting a decade ahead, of course, it'll be subject to all kinds of errors. So therefore, what will be important in that phase is to focus really on the reasons why we're thinking certain things will happen. And then, as we go along, kind of see how the current reasoning stands with what happens at the time, and therefore adjusting our portfolios accordingly. And I think as a last session, we'll specifically just focus on gold, just given, the interest which is there in it, and try to put a framework around, how to look at gold, how to invest in gold, and how to even think about divesting out of it from time to time. So with that, let's kind of get started. Let me start with, the various asset classes, equities, bonds, etc., and how they've performed over the last 2 decades. So let's start with the equity markets. So what we've got over here is almost the entire global equity markets. So we've got the US markets, of course, with the S&P 500 and the NASDAQ. And for those who may not be aware, NASDAQ tends to be much more weighted towards the technology stocks, while S&P is a much more broad-based index across all the sectors. And then we've got 3 MSCI indices, which is the MSCI Japan Index, index, European index, and the emerging market index. So between this, we literally cover all the important markets in the world. The only category left aside is the very small markets, which are known as frontier markets. But I think that we can kind of ignore from the current context. So looking at the performance over the last 2 decades, it's really been like in two parts. Prior to the global financial crisis, which happened in 2008, 2009, the emerging markets was really where all the action was at, massive outperformance by them versus the other markets. And then post that, they've actually not really performed at all. We might have seen some performance in terms of, the Nifty value itself moving up. But when you look at all of this in common currency terms, which is in dollar terms, they've literally not really moved at all. And the emerging market entire basket itself has not really moved at all. On the other hand, post the financial crisis, the US really has had a spectacular run. Within the US also, if you look at the broad-based index, it's given about 7% odd, but the NASDAQ has kind of done almost twice of that. And if you were to just look at the FANG stocks, which is, Facebook, Amazon, Netflix, Google, etc., those stocks have actually given almost twice the returns of what the NASDAQ has given. So very clear where the outperformance has really come from. Let's take it to the bond markets. The bond markets, if you see, have by and large just given a fairly smooth ride over the last 2 decades. The difference kind of really being that if I look at government bonds versus corporate bonds have actually tended to do much better since the financial crisis. The various indices which I've listed over here, the global aggregate bond index, it really refers to a global index of bonds, which is, predominantly about 60% odd is US, and a bulk of the rest is other developed markets, and a small bit is emerging markets. So most of that, so the aggregate bond index looks at the highest quality bonds, so which is largely government bonds and the highest grade corporate bonds. So that's the first one. And then we've got 3 different US bond indices. One which looks at the government bonds over there, which is the Treasury Index. The second one which looks at the higher quality corporate bonds, which is the investment grade bond index. And the third one which looks at the more lower quality corporate bonds, which is called the high yield bond index, or in other words, also the junk bond index. So if you see the 2 corporate bond indices, which is the high yield and the investment grade bonds, have actually done the best post the crisis. The reason for that is that post the crisis, interest rates were brought down dramatically. Now, a lot of investors in the bond markets are typically these institutions like pension funds, sovereign wealth funds, university endowments. All of them have an obligation every year to cater to whatever their constituency is. They may be needing to pay about 5, 6, 7% year on year for their various liabilities. Now, if interest rates are close to zero, it's very hard to meet those liabilities. So you do need some level of interest payments to come in, and that's why the attraction for corporate bonds, which have given a higher rate of return, and especially the more riskier type of corporate bonds. So what we've actually seen over the last decade is a massive buildup in the quantity of bonds which are either at the lower end of the investment grade or more towards the junk bond, the speculative sort of grade bond index bonds out there, because they give a higher yield, a significantly higher yield compared to the treasury bonds. So just bear that thought in mind, and we'll reapproach it a little later in the presentation. From here, moving on to the commodity markets. And what we've got here is the first index is like a composite index, which kind of goes across various categories of commodities, including the industrial commodities, which is like your copper, aluminum, etc., which are used for industrial applications, or gold, oil, and agricultural commodities. And then specifically, I've looked at individually the agricultural commodity index, gold, and oil. Now, gold, as you would have probably tracked, has done pretty well. It did exceptionally well till 2012, almost like a one-way rise, barring a little bit of a blip in 2007 or so. And then went through a fairly extensive corrective period of about 7-8 years. And then finally, over the last year or so, it sort of started finding acceptance again. We'll go into a little bit of detail what really happened in 2012 in the very next slide. On the other extreme is the agri-commodity side, which if you see has been an absolute no-show over the last 20 years. And in fact, if you extend it even further back 20 years, which is right from the beginning of the 80s, it's actually not performed at all. So massive underperformer. And as a result of which, there's really been no flows which have happened in that sector at all. Somewhere in between lies oil as well as industrial commodities, which all had their highs around the financial crisis 2008, 2009. And the big reason for that was a lot of it was getting driven by Chinese demand. They were literally consuming half the world's copper, aluminium, steel, etc. Well, Chinese demand has still been there. It's not really been as aggressive as what it was in the past. Up to the crisis, and therefore these commodities also have not really come anywhere close to their 2007 2008 highs. From here, let's move on to the currency markets. One important difference for currency, which I should point out versus all the other asset classes, is that you always have to ask that what am I measuring it against? So because it's always one currency against the other. So if we say how the dollar is doing, the really important question is dollar against what? And you may have different outcomes depending on what you are comparing it against. Now, of course, for normal context, we end up comparing, how the dollar is doing versus the rupee. But how it's behaving against other emerging market currencies, euro, yen, etc., is also important. And that's what we've kind of plotted over here. We've looked at the euro versus dollar exchange rate. We've looked at the yen versus dollar exchange rate. These are the two most important exchange rates in the world in terms of given the size of the economies they're dealing with and the fact that both the economies are open economies. I mean, China is a bigger economy than Japan today, but it's not an open economy. So therefore, the yuan is not completely convertible into the dollar, and hence it's not necessarily regarded as important a currency. But euro and yen, on the other hand, are completely convertible, and therefore they are the two most important currency pairs versus the dollar. I've also plotted something called the Bloomberg Asian JP Morgan Asia Dollar Index, which is actually just a composite index of Asian currencies. Half of it is China, effectively, about 40% being versus the Chinese yuan and 10% being versus the Hong Kong dollar. The Chinese yuan is sort of loosely pegged to the dollar today. It used to be firmly pegged, and then there was a lot of objection that there was a lot of currency manipulation going on and so on. So instead of pegging it directly to the dollar, they pegged it to a whole basket. But it does tend to move up and down in fairly close correlation with the dollar. The Hong Kong dollar is, of course, explicitly pegged against the dollar, and it moves in a very, very narrow band versus the dollar. The other major currencies there are the Taiwanese dollar, the Korean won and all. The Taiwanese dollar, again, is fairly closely correlated to the dollar. Korean won tends to move a little closer to how the rest of the emerging market currencies are behaving. The rupee is again about 8-9% also of this index, so it's another major currency within that index. The rupee is separately plotted over here for obviously our own consumption, and that by far has been the worst. In fact, if you look at it from 1991 onwards, which is when we had devalued the rupee initially, it's been falling 4-5% per annum, except for a brief period from 2004 to 2007 where it actually went up. But beyond that, it's really been a one-way street. So now looking at these currencies, I think the more interesting one is actually the yen, which if you see has made a high somewhere around 2012 and then seems to have gone down after that. So what exactly went on there? And this has a correlation to that high in gold as well. And let me just talk about that for a bit. Now, Japan historically was the first nation to follow what is known as the Asian exporter mercantilist model, where it was first adopted by Japan and subsequently by the likes of Korea, Taiwan, and China as well. What they were really doing was there was a lot of directed lending by the banks to support certain industries with the objective of making them globally competitive, and over time developing a massive export market as a result of that. So it started with products from Japan and what is continued into products from China today. Now, because Japan had this spectacular growth and all, as what happens whenever there's spectacular growth, sooner or later there's a massive bubble also which forms. So all of that happened around by the mid 80s. There was a massive bubble in Japan in those days, and like a small piece of land in Tokyo was probably worth more than all of California, and that kind of uh, egregious sort of outcomes were seen. But as what happens with any bubble, that sooner or later it will deflate, and that's what happened. Now, normally when a bubble deflates, the currency should also slowly fall off in value, because slowly foreign investors also withdraw from that market. General, interest in that market reduces. But somehow that did not happen with Japan, because they had a lot of savings of their own as well, and somehow they were able to bring all that into the markets, and as a result of which their own currency actually kept strengthening, even while prices of everything within Japan were actually reducing right from the late 80s onwards. So almost like a 30-year period where they've also been doing a lot of quantitative easing as well. However, since they were not reducing their currency and allowing it to appreciate, therefore, the deflationary impact of the reduction of prices of products in Japan never really got passed on to the rest of the world. As an exporter nation, otherwise it would have got passed on. However, all of that changed in 2012 when the current Prime Minister, which was Shinzo Abe, got elected, and he came on with a plank of actually reversing their currency policy and allowing the yen to depreciate and therefore be able to actually avail of, bring in some inflation, hopefully not require as much quantitative easing, and actually spur some growth in the economy. We're still sort of waiting for that to happen, but it has resulted in their currency correcting all the way from about 74 yen to the dollar to about 125 on the other hand, and today it's about 107 odd. Now, what happened because of that, and this is where the link to gold comes in, is that this was a time in 2012 when the world was very worried about inflation. And as a result of which, I mean, if there are a lot of sophisticated investors involved, they won't just worry, they'll do something about it. So they went ahead and bought assets which tend to do well whenever inflationary times come in. And those assets are things like gold, things like inflation protected bonds, where the value of the bond keeps adjusting itself according to the inflation rate, and then even emerging market stocks, which typically tend to do well when inflation happens. And then suddenly you had this major exporter nation, which is Japan, reversing its currency policy and allowing it to depreciate, which meant that now the prices of Japanese products coming into the global markets would reduce because their currency was falling. Now, what does that imply? It implies that the countries which compete with Japan, which is specifically Germany, because that's the closest competitor in every sense, and also to some extent Korea and China. So between them, it's literally the major European bloc as well as the major Asian bloc, which is also forced to reduce the prices of their products because the Japanese products are becoming cheaper. So effectively, the deflation of Japan gets exported all over the world when you shift your currency policy, and that's what happened. But it was a world where everybody was positioned for inflation, and you have a major macro deflationary event happening, which means that inflationary assets are the wrong position to be in and they will sell off. And that's exactly what happened since then. I am also going into this in a little more detail, but because some scenario somewhat similar to this, although the reasons are different, but an overall market scenario somewhere similar to this is also building up currently. Okay, so that's it on currencies. From here, let's now move on to interest rates, because interest rates really are, pretty much core to how you price any kind of asset. So what we plotted over here is the interest rate on the 10-year US government bond, as well as something known as the real rate of interest, which is the interest which you see on a bond. And if you subtract inflation from that, which means if you adjust for inflation, what is the actual return you're making? So that's what is plotted over here. The green line is the normal bond and the black line is the real rate of return. after I've deducted inflation from it. So if you see, the trend is broadly the same. 7% inflation odd, which is now down, 7% interest rates on the 10-year government bond, which is now down to about 0.7% or so. So literally 90% of the yield has gone. And if you in fact plot it all the way back to the early 80s, that's reduced from almost 17, 18% at that time down to the 0.7% which we have here. Just think about that for a moment, because what it really means is that for 40 years, we've had an enormous tailwind of reducing interest rates, which is very, very beneficial to bond markets everywhere. It is very beneficial to all asset markets because the cost of borrowing simply has become cheaper and cheaper. Now, while I've plotted the US here, it's the same story irrespective of which country we look at. It's pretty much been the same scenario. Now, what is the link between these interest rates or the bond yields and equity valuations? That's worth spending a bit of time on, because the yield which you get out of a bond is somewhat similar to the yield that you get from a stock. What does the yield from a stock really mean? It just means that, what are you earning on the stock? Like if you were an owner of the company, what is it that you're earning? So the yield on the value of that stock, which is known as earnings yield. So now a bond is supposed to be a little cheaper than, a little less risky than a stock. So therefore, bond yield will be a little lower than whatever is the earnings yield. Put another way, earnings yield should be a little higher than what the current bond yield is to make sense. Now, if you invert earnings yield, it's basically the price to earnings ratio, because earnings yield is E by P. If I invert it, it's P by E. Okay. So if I can have a figure for what is the limit on my earnings yield, I can also therefore have a figure for what would be the limit on, or at least like a fair value for the P ratio. So let's assume the bond yield today is 5%, which means that my earnings yield should be a little above 5% at the very least. Now, if I invert that, which means that inverting 5% is 20. So 20p is like a fair value for the market. And if it's above that, it's obviously overvalued. And if it's below that, there's probably an element of undervaluation. The market could, of course, trade above or below that, but this is just an indicator of value. Now, all of this calculation goes a little out of the window when bond yields fall below 1%. Because now when you start inverting it, and especially when they head towards 0%, and in some cases they've gone negative as well. So because now if you invert it, just using maths, it literally means that your P can be infinite. Now in reality, of course, it's difficult to have infinite P and all that. But what it really means is the whole exercise of trying to figure out what the fair value or a fair valuation for a company is or a market is becomes very, very difficult in an environment like this, because depending on how close the value or the yield on the bond is to zero, you could have anything, you could justify anything from 50p to 200p to 500p. It's all the same, because it's literally tending towards infinity. Of course, if anything happens to those yields and they shift a little bit here or there, then suddenly the markets also do a readjustment. And that's where this whole real yield comes into play. Because whenever you have inflation, so real yield, remember, is the bond yield minus inflation. So if there is some inflation, then real yield actually becomes negative. So if real yield is negative, then it makes sense to have anything which gives a slightly positive yield, and you invest into it. On the other hand, if there is a fall off in inflation, what is known as deflation, the very opposite scenario happens, which is if we take the example over here, that let's assume interest rates today are, bond yields today are around 0.7%, but there is a deflation of minus 3%. So if I deduct the two, then you actually have like something upwards of plus 2% real yields. And that suddenly changes what the acceptable PE can be. So what was probably tending to infinity before now has a value of probably about 50 or so. So when a readjustment happens. And this kind of a readjustment can happen very, very quickly. And that's what typically happens during any kind of sell-off. So slightly complicated, some of these things, but just keep in mind that as interest rates become closer and closer to zero, trying to actually have an objective measure of valuation is very, very difficult. From here, let's just dive into what's really been going on currently. And for that, let's now combine bonds and equities. What I've got over here, the white line is again that same US 10-year bond yield, and the orange line is the S&P 500. So the first is a proxy for bond markets, the second is a proxy for equity markets all over the world. Now, bond markets typically tend to be closely correlated with what's actually happening in the economies, for a very simple reason that in a bond, you're really just concerned about whether the next interest payment will come or not. And if it's not coming, then there are issues. And when that happens, typically you tend to discard all the risky bonds like your corporate bonds and all, you tend to discard all that. And you go towards the safest bonds, which is government bonds, because you're more or less guaranteed that you'll get your money back over there. So when yields on government bonds tend to go down, it really means that there is trouble in the economy. You're not finding enough investment avenues anywhere else in the economy, so you're coming and buying government bonds. If you buy government bonds, the price of the government bonds go up. If the price of the government bonds go up, the yields tend to go down. That's a simple sort of correlation between the price and the yield. So if you look at this chart, what it's really telling you is from the middle of 2018 onwards, the bond yield kept going down. On the other hand, throughout 2019, equity markets were still going up. So I was saying that the bond markets tend to be closely correlated to what's really happening in the economy. On the other hand, equity markets seem to rely a lot more on hope and emotion and sentiment. And there's a good reason for that also, because a lot of it is built around future expectations of what a company may do or what a country may do and so on and so forth. Now, when you're building future expectations, you obviously don't know. And there are times when you will be enthusiastic about the future, and then there are times when you will be extremely depressed about the future, and that will get reflected in the behavior of the markets. So just keep that in mind. Bond market, closer indicator of the economy. Equity market, closer indicator of sentiment. So now let's go to 2019. And if you were looking at 2019 and you saw the bond yield, you could make out something is wrong. The bond yields are going down one way in a fairly dramatic fashion. But if you were a central banker, you couldn't really do much about it. You were reducing interest rates, which they were all doing, but you couldn't do a whole lot about it because sentiment was still pretty good. Equity markets were on their way up, unemployment levels were pretty low, and Trump was tweeting continuously about how well the equity markets are doing. So how do you justify doing any sort of extraordinary measures to save the economy at a time when sentiment is good? You'll really be questioned for it. And central bankers also are are sort of bureaucratic officials at the end of the day. So it becomes difficult. So if you were a central banker, in some ways, you were almost hoping for a crisis to happen, because once a crisis happens, you have all the air cover you need to actually go ahead and implement some serious measures to hopefully arrest the decline in the economy. Now, this crisis took the form of Corona. I don't think anybody would have really predicted that. But sitting in 2019, clearly you could have figured out that you need a crisis for the central bank to act. That's really the big takeaway, if you will. And then, of course, once the coronavirus hit and all that happened, between February and March, you saw a very quick readjustment between where the equity markets were thinking and what the bond markets were thinking, and sort of, they converged very quickly. Of course, since then, again, a fairly wide divergence has happened, where equity markets are again off to the races, whereas bond markets, especially the 10-year bond yield, has actually not reacted at all. This is a slightly dated chart, but even if I look at the chart today, the 10-year bond yield is literally around the same levels, maybe slightly higher. So what it's really telling you is that sentiment, for whatever reason, the equity market believes things are going to be fine. The bond market somehow is not buying that logic. And over time, usually the bond market tends to be right. So do keep that in mind. Now, however, let's come back to what's really going on here. We've seen that the Fed has come and done all kinds of quantitative easing. You may have seen the numbers also in various infographics which are circulated around. So basically their balance sheet, which was already fairly high, has gone up even higher. So it was about $3-4 trillion or so at the beginning of this year, and that's literally doubled from there. Now that's a massive increase in their balance sheet, although as a percentage of GDP, it was probably about 15-18% of the GDP, and probably it's about twice of that today. Now, if the balance sheet, I mean, what does balance sheet expansion even really mean? It just literally means they've created that much more currency to come into the system by issuing, more bonds, which have then been subscribed by the bank, and so much of currencies have been released into the market. Now, if that much more currencies have been released, you would normally expect that the value of currency should come down to reflect that increase in the quantity of currency. But that's not happening. If you look at the dollar index on the right, it's literally at the same level as what it was prior to the crisis. Now, this dollar index is the DXY, which is against the major developed markets. But even if you look at some of the indices against the emerging markets, it's the same story. So something is off over here, where theoretically you would expect the dollar to weaken, but nothing of the sort has happened. So what exactly has been going on? This kind of brings us to two important structural imbalances in the global financial markets, which also lend themselves to the major risks which exist in global financial markets. And a lot of it is not visible, and therefore I'm just making my best to try and highlight that to you over here. The first one really is the relative size of the markets. Now, whatever we were talking about, all this money printing, all of that is a function of some percentage of GDP, 20% of GDP, 30% of GDP, something like that. But how big is this overall GDP is the first question. And that, if you see, is about $70-75 trillion. The little circle called economy, that really refers to the total GDP around the world. It's about $75 trillion worth now. The other one is total equity markets, which is again the total market capitalization of all the equity markets around the world. How much does that total up to? It's approximately the same size as the total GDP, roughly about $75-80 trillion odd. But how big is that relative to other asset classes? That's a really interesting one to look at. So firstly, let's look at it relative to bonds. And you see that there are almost $250 trillion worth of bonds in circulation, which really means that if I were to look at it in terms of a debt equity ratio or a debt to sales ratio, bonds are about 3.5 times the size of equities, the total equity issuance, and about 3.5 times the size of total sales, because GDP is like revenues or like sales. So by any metric, that's very levered, because typically anything which is more than 1.5 to 2 times debt to equity is typically, I mean, unless it's a bank, of course, it's typically regarded as being fairly risky. So which almost means that the global economy is very levered, and in fact almost like a bank in some ways. So it's more a global financial economy than a global real economy really, which is what it really is. And then if you start going further up, if you look at the total real estate value around the world, approximately $300 trillion. Again, keep in mind that significant parts of the value of real estate is again usually via leverage. I mean, there are loans and all which are given for it. So there's a significant component of leverage again attached to that. And then if you look at some humongous thing called the derivatives market over here. Now, this is different from the derivatives market, which you may be familiar with, which is the futures and options that are traded on the exchanges. What I'm referring to over here is something called, the over-the-counter derivatives market, and it predominantly is comprised of interest rate swaps. What that refers to, for those who may not be familiar with that term, is that let's say I have an obligation to pay a rate of interest which goes up or down depending on how the interest rates in the economy are behaving. And I don't want to take that risk of, the interest rate going up and down. Instead, I want to pay a fixed rate of interest, let's say for your house. So instead of a floating rate of interest, I want to pay a fixed rate of interest. So I could potentially have a transaction where I borrow a floating rate of interest from somebody and I swap it with a fixed rate of interest from somebody else. There's a way you price all that, which we'll kind of not really go into right now. But that's a very common transaction. So this market is just gigantic. And it's it's literally a market which is a big boys club, if you will. It's really the institutions which participate in this market. It's not really a retail market at all. But it's one-to-one. You can structure products whichever way you want to. You can structure these transactions whichever way you want to, but it's humongous. Let me give you an example of a very, very typical type of product here. So let's say there's this pension fund who thinks that India has good prospects. And it goes and tells its investment bank that give me $100 million exposure to India. For that, essentially, instead of buying $100 million worth of Nifty or something, you essentially just give me what the returns are going to be over the course of the year. So if it moves up 10%, then let's say 10% of 100 million, which is you give me $10 million on it. So investment bank also says, fine, happy to do that. For that, I'll charge you something. And it charges the pension fund maybe something like LIBOR plus 300 or something like that, which is whatever is the LIBOR rate plus 3% above that or something like that. It may charge him for giving him this exposure. So they enter into that transaction. They exchange a few $1 million here or there to just make sure they both have margins with each other. And every month they probably keep settling their margins, just the way you do the same when you're trading futures and options. And if, let's say, hypothetically, the Indian market actually goes up about 10%, then on whatever $3-4 million he's putting as margin, he's able to make $10 million on it, which is a fantastic rate of return on the capital employed. So that's what makes it so attractive. And for the investment bank also, what they would have typically done is they would have probably entered into this leg of transaction here and maybe done another transaction with somebody else to offset that leg somewhere. So all of this functions pretty well in normal course of action, and because of which it's a massive, massive market. But the net exposure is not that much. So if I'm looking at, I've put a figure called 1,000 trillion over there, or a quadrillion. The net exposure between the two may be a fraction of that, say 5% of that or something, which is say 50 trillion or something like that. However, whenever a crisis hits is when all of this breaks down. Because when a crisis hits, I no longer trust the party I am entering into transactions with. So I may pull the credit lines with that party. And in turn, that party may go and pull the credit lines with somebody else. And this becomes like a ripple effect across the big financial institutions. And suddenly, while, my position involved being, buying something from one side, selling it off to the other side, because of which my, net exposure was quite low. However, if one leg of the transaction has suddenly got shut down because of issues all over the market, then my other leg has suddenly got exposed. And because of that, this low net exposure suddenly becomes a very, very large gross exposure. And that means all kinds of ripple effects on the financial system itself, because immediately somebody else will start asking for margins, and then you have to find a way to give those margins. So you have to go sell something else. So a lot of times, people try and come up with cute explanations of why markets fell or, what happened and all that, let's say in the Feb-March period. But a lot of times it's just a result of, trying to meet margin obligations in this massive, massive derivatives market. The only difference is that nothing much is known about these markets. So unless you have friends who work in various of these investment banks and all, you really wouldn't even know of their existence. Very little is talked about them in the media either. However, you can just look at the relative size of it and understand just how important it is. And it's literally like a tail wagging the dog situation. You improve the conditions in the massive leverage markets, and conditions can improve in the markets which we see, which is like equity markets. And if you pull up all of these enough, the economies can also start looking better. So it's almost the reverse way around, although we tend to think from the bottom up, which is if economy does well, then everything else will do well, and so on and so forth. Okay. The second big imbalance, and this is really the last part of this session, the second big imbalance, which is worth talking about, is in the global currency system. And that is that the current currency system has the dollar as the reserve currency. And this has been in existence since 1971, post something called the Bretton Woods Conference. Till then, dollar was pegged to gold, and it went off the gold standard at the time. And it started freely floating as a currency at the time. However, at that time, the US was more than 40% of global GDP. Today, it's about half of that. And it's not because the US has degrown, but because the rest of the world has expanded significantly, of course, led by China, but many of the other emerging markets as well. And therefore, today, the US is a much smaller part of the overall global GDP. However, the US dollar is still a very, very big part of the entire financial ecosystem, which is whether it's transactions happening in the actual asset markets or it's transactions happening in the import and export area, or call it what you will, about 70-80% of transactions happen in dollar terms, which means the dependence on the dollar is significantly larger for the global economy as opposed to the dependence on the US economy itself. And that is a big, big disconnect today. It's the 80-20 rule sort of in reverse. On top of that, most of these transactions happen through a system which is controlled by the US called the SWIFT system. So if you ever were to make a remittance, you would have your bank would have used the SWIFT system to do it. This again is completely controlled by the US. So now put yourself in China's shoes, where whenever the US wants, it really can shut off China from the global financial system via, either by doing something with the dollar, by weaponizing the dollar, or by shutting them out of the SWIFT system. So this is a significant imbalance today, for which again there is no easy solution. And somewhere we have to figure out where we reach from here, and the path to do that will also play a part into what our outlook is over the next decade or so. So just to summarize everything to date, I kind of went through what has happened across markets. It's been, there's been a divergence between what happened prior to the global financial crisis and what has happened post that. We've kind of based that to look at what's really going on right now, where different signals are coming from the equity markets and the bond markets. And where is, some of that, all of, what's really going on behind the scenes, which is really the structure of the markets, the extent of leverage, which is really out there in the global financial markets. And secondly, the big disconnect also, which exists in the global currency system today. Sorry, one little part which I didn't touch upon this, on the currency part, is that why this is a problem, is that the US dollar is almost like two things. One is the US dollar which exists within the US, and the second is US dollar which exists all over the world. US dollar within the US, if there is a shortage of it, the Fed can supply. It can print money and supply it. But if US dollars outside the world, which is required by many companies for all these transactions, and it is required by financial market players as well, if there is a shortage for the same, then the Fed cannot just supply that. It can open up swap lines with different central banks where it can loan them some dollars so that they don't have to go chasing for dollars in the market, but it can't literally print dollars and give it to them. So that's the reason why this big imbalance exists, because if for whatever reason there is a shortage of dollars, there's a demand of dollars outside the US, it is going to be very hard to fulfill it. What can cause that is the big amount of leverage which exists around the world. Leverage means you have to pay interest. As long as you're generating income in some way or the other, you're able to pay interest. But if that revenue gets cut down, which is what has happened with Corona and all that, then it can be a problem to pay back the interest. If you're having issues in paying back interest, then usually you'll struggle to, find the money to pay it. A lot of that interest is actually denominated, a lot of that debt is denominated in dollars. So you'll struggle to find dollars to pay it because just not enough dollars are circulating as the economy is broadly shut down. And that is what lends itself to the issues which are there. So keep that as a takeaway, and then we'll use it to get into what the future may hold for us.